It's our great pleasure today to focus on an ambitious and highly informative report. And before I do that, I just want to give you a bit of background about the Wilson Center itself for those of you who are new to us. We were established in 1968 as a living memorial to, of course, Woodrow Wilson. He was the only U.S. president to have earned a PhD, and in his era, he was a very prominent political scientist. He went on to be president of Princeton, governor of New Jersey, and of course, a two-term president. When Congress set us up, they wanted us to bring together, in effect, both sides of Wilson's life. People who were doing the best thinking about the future, thinking about public policy, together with people who were making or influencing public policy. And today's report is a marvelous example of that best thinking about the future that will help inform the choices that public officials actually make. This is the World Bank's latest Global Horizons report, Capital for the Future. It looks at the pattern of savings and investment that is coming over the next 2 decades, looking forward to 1930. The World Bank describes itself as working for a world free of poverty. And I must say that this report contains some optimistic news about the future. One of the things that really impressed me so much is the sheer ambition of the report. We know how changeable the future can be, and they look at 2 different scenarios, one of which predicts convergence, the other a more rapid convergence between the emerging and developing world and the already OECD more advanced industrial economy. And it made me think back to one of the people that Americans like to quote the most, Yogi Berra. For those of you who are not baseball fans, Yogi Berra was a very famous catcher, really had an American-wide, perhaps worldwide reputation, and he was known for some of his most pithy remarks, one of which was, predictions are difficult, particularly about the future. But our 2 specialists here, our 2 economists, are not deterred by that particular wisdom of Yogi Berra. So let me introduce the 2 presenters. They will later be joined by 2 commentators. And I'll introduce the commentators when they join us here on the podium. Hans Timmer is the Director of Development Prospects Group at the World Bank. He's got a host of impressive background, including Central Planning Bureau for the Netherlands. Planning, of course, is a word that's not used quite as often here in the United States, but is common in almost every other country. Also joining us is Maurizio Busolo. I embarrassed myself by trying my Italian, which is, as you know, based entirely on the Godfather movies. Maurizio is the lead economist who put together this Global Horizons report. He has been at a host of places, economist at the OECD Development Center, a number of other distinguished institutions, including the University of Los Andes in Bogota, Colombia. Both of these researchers, economists, have published widely. No doubt you'll pick up the Financial Times or an academic journal and find them quoted or published. And they have consented to join us today to give us an overview of this very ambitious and important report. So let me turn the program over to them.
Thank you so much, Ken, for that introduction, and thank you for organizing this event. It's a great opportunity to discuss the report for us. Good morning, everybody. Thanks for coming. Ken told me just before we started that Yogi Berra also said, if you see a crossroads, take it. I thought that was very appropriate here for the building. You should have that sign almost at every corner, because I got lost. If you see a corridor, take it. So indeed, we are discussing today the second report in a new series that the World Bank started, Global Development Horizons. It is a series that tries to analyze emerging trends, looking ahead decades even, so taking a very long-term perspective focusing on structural changes. The first report was about the emerging multipolar world. What is the consequence that there are new growth poles now in the developing world, the diminishing role of the United States in the future, the diminishing role of the dollar. Other topics that you can expect in the future are we at the start of a downward trend in commodity prices because of a global super cycle? Or what are the consequences of the fact that in developing countries now more and more skilled people are graduating from colleges? That will change the dynamics in global markets. But this second report is about the future of investment and saving. And I think I have a device here that, yes. I would like to start with you where we started ourselves this project, and that is by asking 3 questions. The first question was, where will investment be in the next 2 decades? We know that the investment rate in developing countries recently has risen a lot. Developing countries are growing, huge investments in China, but India might follow up also. So where does that leave the high-income countries? What does that mean for the overall investment opportunities? What does that mean for the numbers? And then the second question that we asked, okay, if we have an idea of how large investment demand will be, will there be the saving, will there be the income that is not consumed to finance those investments? Not too long ago, McKinsey had a report where they thought that there would be again a period of shortage of funding, so a period of rising interest rates because of aging, savings would decline, and still you have that huge demand for infrastructure investment and for other kinds of investments. So the second part of the report will address the trends in saving behavior, looking at both the macro developments and the microeconomic developments. And then finally the question is, okay, if you have an idea of potential trends in investment and saving, what does that mean for the financial markets, whose function it is to bring savings and investment together? What does it mean for the intermediation? And it might be that there is no surplus or shortage of saving, but there is a problem in the intermediation, especially when the character of the investment is changing, either because of shifts over countries or because of shifts over sectors. So those were the 3 big questions that we asked and addressed then in the report. We will divide this presentation into 2. I will talk about the first part, the general trends in investment, and then Mauricio will take on the answers on the other 2 questions, and he will end then with some discussion on the policy consequences of the whole report. So, which countries will drive investment in that future multipolar world? Those investments are ultimately all driven by productive opportunities, by growth in the world economy, which is driven by productivity growth. So let's take first a step back and look what happened in the past before we go into the future. And the past has been already very, very exciting. What you're seeing here is underlying trend growth in the developing world and in high-income countries, starting in the 1960s up to very recently. And what you're seeing is that something dramatically changed at the beginning of the 1990s. That is where structural growth in the developing countries delinked from structural growth in high-income countries. That was the result of major transformations, both internally in developing countries and in their relation to to the world markets. Developing countries opened up and integrated into global markets, and they stabilized their macroeconomic policies, and they changed a lot of their structural policies in their own economy. It resulted in a sharp acceleration, while high-income countries did not accelerate. So that is a starting point for us when we look into the future. If you look at actual growth, that means, if you look at cyclical growth, that means actual growth in deviation from that structural growth, then you see that the world is more and more integrated. And even the big crisis of 2008, you see that the cyclical downturn in high-income countries was exactly the same as the cyclical downturn in developing countries. So in that sense, we live in a very integrated world. The underlying growth is accelerating in the developing world. We have a delinking, but that is because developing countries are integrating into the global market. As a result, we have one big global cycle, and as a result, developing countries' impact on the global economy is becoming larger and larger also. And one of the reasons why the impact of developing countries in the global economy is so large and why they were able to accelerate is because of investments. And what we are seeing here is over the last 5 years of the first 10 years of this millennium, the contribution of developing countries to global growth in investment. And what you're seeing that less than 10% of global growth in investments came from the high-income countries. 90% of that growth came from developing countries, half of which came out of China. It is not that the share of developing countries in global investments is already 90%, but because they are growing very fast, the contribution to growth is so important. That is behind the acceleration of growth in the developing world. It is also why developing countries are so important in the global cyclical developments, because investment is a very cyclical component of overall production, and the import content is very large. So that is the background. Acceleration of developing countries, a huge role in global investment. And so you have to design scenarios for the future depending on plausible trends in productivity, depending on population developments, to have a background to talk about investment in the future. And so what you're seeing here is, again, GDP growth for the high-income countries at the bottom, then for the developing countries, excluding China, in the middle, where you see the deviation that started in the 1990s, and then China itself, of course, already growing 10% a year for 30 years. And then what we did here is we put different future scenarios that we used in different studies in the past to build up a range of potential future scenarios, where you see a couple of things. First of all, it is very likely that developing countries will continue to grow at a faster pace than the high-income countries. That means we'll continue to converge. The share of developing countries will continue to rise. It's very difficult to imagine that suddenly would stop. But at the same time, it is also very likely that the growth rate in developing countries will slow down for demographic reasons, for reasons of structural change within those economies, and for the reason of the fact that they are approaching more and more the technological frontier in many sectors, and then it's much more difficult to get high rates of productivity growth. That slowdown is especially sharp in the future in China, again, for all kinds of reasons that we could discuss later on, but I won't go into now. So if you look at the baseline scenario, if you want, the low case scenario that we use in this report, then you see that same kind of picture, high growth rate in the developing countries, that will continue in the next decades compared to the high-income countries, but on average a slowing of growth in the developing world. It masks sharper slowing in some countries and no slowing in others, no slowing in Africa, sharper slowing in China, for example. Now that is the background to analyze demand for investments or investment opportunities, how much factories you need, how much infrastructure you need. And this is a picture that summarizes what is likely to happen in that standard baseline scenario in this study with investment demand. Still very high in China, but the investment rate sharply declining, and declining also in India and in other countries. So that's the picture, the baseline picture, high investment rates but declining. And if you would look at high-income countries, you see the same kind of picture. We expect almost in every country a declining investment rate. But then if we aggregate that to the global level, then we see that for the world economy, the investment rate, the investments as percentage of GDP, is not expected to decline, and actually also in the past has been very, very stable. It is not expected to decline because despite the fact that in developing countries the investment rate is declining, the share of developing countries in the world is rising, and developing countries have a higher investment rate than in high-income countries. So if you aggregate that up, then the global investment rate will be stable. So actually, after doing a lot of work and exploring a lot of the opportunities and going into structural changes in all those countries, you add it up and you say, okay, not a lot will happen in the world economy, at least on the investment side. But then, when you look at the composition of investments, there will be dramatic changes. And dramatic changes that, to some extent, we have seen already over the last 10, 15 years, accelerated by the crisis. But in our view, that change is not temporary, but that change will continue and will become even more pronounced. So the share of investments done in developing countries of the world was for a long time roughly 20%. It is here as percentage of global GDP, but you can see it also as share of global investments. Then it was roughly 20%. 80% of the investments for decades were done in the high-income countries. That share after the crisis has increased to almost 50%. Half of the investments now are done in developing countries. And even if we have very cautious and moderate expectations about the future trends, then that share will further increase. In the lower scenario, it will increase to 60%. In another very plausible scenario, it will increase to almost 70%. So 2/3 roughly of investments in the next 2 decades will be done in the developing countries. That is a dramatic change from how the world was for decades. Suddenly the developing countries as the major place where investment is done, and that is of course a flow variable. Investments, the accumulation to the capital stock every year. That is not the amount of capital stock in the world. If you look currently at the capital stock, only a quarter is in the developing countries. Still 3/4 in the high-income countries. But then, if you fast forward 20 years, because of that rising share in investment in the developing world, then you see that half of the capital stock 20 years from now will be in the developing world, of which almost half is in China, only half in the high-income country. So dramatic changes if you are looking at the investment side. Then the big question is, of course, will the savings be there to finance all those investment opportunities or investment needs, if you want, in the developing world? And the question is, what are the consequences for financial markets if suddenly the developing countries are so dominant in the need for investments? And that is where I give it to Maurizio. Thank you.
Thank you, Hans. I just keep going then. So the next two questions that Hans introduced are about the savings and how to match investors and savers. As Hans mentioned, there was this report that McKinsey put out, and one of their issue was that they foresee a lot of investment activity, a lot of demand, and they foresee a drying up of savings. Our view are slightly different from McKinsey, and the answer comes from the saving side comes from considering two things. One is in general savings as investment are driven by growth, by income, and the developing world will grow faster, and they will basically demand more investment, but their income growth will also produce more saving. The second reason is maybe a little more tricky and comes from a kind of paradox, a composition paradox, that we will foresee indeed, because of demographic pressure, a reduction of saving rate for both the high-income countries and the developing countries. But at a global level, we don't foresee a reduction of saving rate. This is because the developing countries that are high savers, they will become larger and account for a larger proportion of the global income. So here you have the paradox explained. You see that the developing countries on the graph on the left-hand side, you have the saving rates for the two parts of the world, the high-income countries and the developing countries. And you can see that there is a big gap between the two in terms of saving rates. And also you can also see that the gradient of the saving rate is slightly different, with the high-income countries saving rate going down. But more importantly, on the graph on the right, you see the share of global GDP, that right now is about 2/3 of the global GDP are accounted for high-income countries in around 2010, and 1/3 is for developing countries. But these trends are very different, and by 2030 there will be about 55 and 45. So the growing importance of developing countries, which are saving more, will contribute to the global supply of savings. So indeed, this at the global level, everything seems all right. So it seems that there will be enough savings. But at the regional level or the country level, the story is a little more complex. Let me give you a little bit of information on the actual demographic trends. But before explaining you this graph, let me give you one interesting statistics that maybe it's not that surprising, but the first time I actually saw it, it was surprising. Basically, by 2020, 7 years from now, of 100 new entrants in the group of people in working age between 15 and 65, of 100 new entrants, 100 will be from developing countries and 0 from high-income countries. In 15 years later, 2035, 2040, 110 will be from developing countries and -10 from high-income countries. So this is, I used to give these statistics, especially when I was traveling in Europe, that everybody was worried about will the euro will be here or not. And no matter what happens to the euro or to the dollar or to the rupee, etc., these demographic trends will probably be there. Okay, so going here to this graph, this shows you a ratio of the working age population to the total population. So it's a kind of the inverse of the dependency rate. Okay, And it's interesting, this graph has a lot of information in it. It's the information is basically through the shape of the curve, so how steep the curve is, where in the timeline the peak is reached, and the height of the peak. So you see, for example, that high-income countries, the pale looks gray here, blue on my screen. The pale gray high-income countries have already reached a peak a few years back, and are already on a fairly steep descending curve. So, in other words, the dependency rate is rising very fast. East Asia and Pacific, especially because of China, have a very steep ascent and a very steep descent, and they have reached a very high peak. So there has been a period where this generation, as the reduction between mortality and fertility has been very close because of the one-child policy, and they reached a very high peak, but they are already on a descending. Latin America will reach a peak in a few years from now. There is no South Asia here, but India will be one of the countries with the highest ratio in a few years from now. Indeed, I presented this in India, and there is a whole debate about the demographic dividend in India, but I don't have the time to go into that. And one last thing about this graph that is noticeable is that Sub-Saharan Africa is far from having reached a peak, even in the time horizon of 2050 in this graph. So it's a very young, still growing continent. These demographic trends, as well as the productivity and the growth of income, determine the availability of savings. And here you have the saving rates. And of this graph, note that, as I said before, all the regions are coming down, but there are differences in the gradient with which they come down, and the level of the saving rate. Noticeably, again, because of demographic trends and productivity and income growth, Sub-Saharan Africa is the only area in the world which has a non-decreasing saving rate for the period under which we run our simulations. In terms of actual, everything that I gave you now is in terms of rates, or in terms of their income. Now is this picture gives you how much actual savings in terms of amounts, absolute amounts are available, and you see that these are trillions dollars, and you have two axes. The right axis is for China, which is on a different scale because of their amounts are so large, and the rest is on the left scale. You can see that India, China will surpass the savings of the other countries much earlier than the actual intercept, because they are on a different scale. Okay, but India will become the second largest savers in the world by towards the end of our period under analysis, and will surpass the USA savings, the Japanese savings, which are large savers. So the one consequence of that is, going back to the beginning of the question, is what happens. So what happens now? We have the availability of saving at the global level, the availability of investment at the global level. And so at the global level, we don't see a pressure on the interest rate. Here you have somewhat maybe a misleading impression that the interest rate is so stable, that dotted line. that because actually is an average of the interest rate for each country. But indeed, there are some pressure in some countries, and the interest rate may rise in some countries. But at a global level, we don't see that there will be a high pressure and a lack of saving to finance all the investment opportunity that Hans has described. So up to now, I have talked about savings without really defining who the savers are in terms of institution, either if it's the household private savings, individual savings, or firm savings, or of government savings. And there's a part in the report where we discuss the savings of these three institutions, but most of the savings at the macro level are determined by the household sector. Obviously, in some countries it's different, but at the global level is that. However, in the report we also look at the pressure that there will be for government savings going forward. And in this graph, which considers a specific type of pressure on government savings, there are a few examples for the pension, age-related expenditure, and these forecasts are done in a very crude way, so they don't allow for changing policies. They basically just account for an increasing in the population of pensionable age. And you see that for some countries, the pressure, if nothing changes, is quite dramatic. Brazil is a country where the pension system is very generous, so if this does not change because of aging, there is a 10%, about 10% increase in the expenditure related to pension. Obviously, there is another pressure that is related to age, which comes from health expenditure. In these countries is well-known, the debate about that. But for other regions is also important. And it's we also looked, there will maybe be savings because of education expenditure will go down, because again there will be less young people, but it's not actually the case, because education keep increasing even if the young people are less numerous. The quality of education, tertiary education kicks in, and so on. So there will be pressure for some countries on the government saving side that need to be addressed early on. Let me get to the last question, and which is about how the financial intermediation comes into play in this new world. Let's start from this. Basically the story up to now is that, okay, for a few decades, as Hans has put it, the developing countries were a minority in the global arena of investment demand and indeed of savings. But we see that the world in the future will be quite different. And in the future, in 2030, about 2030, developing countries will be playing a major role, will be demand there for investment about $66 to 70 and something dollars to $100. So 2/3 of the investment or more will originate in developing countries, and likewise savings will come from developing countries. So but this graph shows you that in terms of intermediation, and this graph shows the global gross capital inflows, and the role that is played by developing countries is minuscule. So most of the intermediation at the global level is still happening in high-income countries. We do forecast what's gonna be the future for these statistics, and we see that the world will be very different, and about 50% of these flows will be originating and going to developing countries. So this seems like natural. You see that the world there will be more investors, more savers in developing countries, but this is a huge transformation, and it requires. In our model, there is nothing mathematically difficult to happen, but it requires a lot of transformation of the financial sector in developing countries, a lot of deepening of the financial sector, and it's going to happen. The time scale that the financial sectors have developed in high-income countries have been 50, 100 years. This is 3 decades barely. Okay, in high convergence scenario, so an even faster scenario, you see that the share will be even larger. So that again, I want to emphasize that this is a tremendous change. The current largest banks are still in high-income countries, and their share of business is increasing in developing countries. But this requires new banks, new institutions, new financial institutions arising in developing countries. Although it may seem exaggerating, maybe it seems exaggerated, how can this transformation happen? These guys are just running models and producing numbers that seems exaggerated. This is the same graph, but with a slightly different type of statistics. So instead of being actual flows, actual trillions of dollars, this is in terms of flows in terms of GDP. Okay, so the blue line is what has happened until now. The dotted line are the 2 scenarios, and the sort of diagonal line is basically an extrapolation. Okay, so if we extrapolate what has happened in the last 10 years, you see that we go even above the 2 scenarios, the standard scenario and the high growth scenario. So our high growth scenario is in some sense even below what has happened in the last few years, a decade or so. So we're not exaggerating in some sense. Now, I don't want to give you a sense, and perhaps Hans and I have given you up to now a sense that the future is rosy, the developing countries will become big and prosperous, but there are a lot of challenges ahead. And as I said, in the models, things happen if you assume that certain policies are there, but the reality is that certain policies are difficult to implement and are challenging for policymakers to make it happen. And I give you just a brief overview of this here. The one challenge on the investment side, you see these 2 graphs are relevant for sub-Saharan Africa, and here you have the 2 scenarios. One which is the standard scenario, the gradual convergence, and the other one that is the fast convergence. And you see that just focus on one number, or on 2 numbers. On the gradual scenario, the institutional quality is is stable. The bars are stable, so we don't foresee an increase in the quality of institutions. Whereas in the high growth scenario, high convergence, faster convergence scenario, we foresee that actual policies are implemented to improve the governance in many countries in sub-Saharan Africa. The cost of not improving this policy is the difference in terms of investment that can be done in this continent. So instead of having $660 billion invested by 2030, there will be only $556. Now it's $100 billion, so it's a large difference. But I want to emphasize one other point here, and that is that what really matters is the difference in regional improvement. So here, when we ran the model in the fast convergence, every country improves its institutions, its policy, etc. But in the real world, it may not be so. And so in the real world, it may be the only one region does well and another region does not well. And then the relative difference there is what really matters. So in a world where there will be so much more opportunities in the developing world, if you are a country that doesn't implement policies, the cost that you pay in terms of lost opportunities is much larger than today. So that's an important thing to remember. One other challenge comes from the fact that, okay, we see that between countries, in terms of stock, between countries, the distribution of capital stocks and of wealth, which is about the same, is going to become more equal. So that's a positive development, if you wish. But what happens within countries is not the same. So indeed, in the recent past, for many developing countries, we have seen an increase in inequality. And when we look at inequality from the point of view of the savings, and we look at data for household savings, we see that inequality within a country is actually still very, very high. In this graph, you see the total savings in Mexico for 2010 distributed among individuals that are ranked in their by decile. So from the poorest on the left to the richest decile on the right. And the richest top 20% basically are owning most of the savings. And the poorest 20 deciles are actually de-saving. So they have negative saving. They are consuming more than their actual income. This is the second graph shows you the difference in the distribution for income and for savings. And this is a Lorentz curve. This is a standard way of looking at inequality distribution. And the diagonal would be basically every percentile of the population has the same percentile of income, but the curve under the diagonal means that is how unequal the distribution is. The blue line is the distribution of income, and the red line is that of savings. You may think that this may not matter so much because the people that are on the lowest decile, maybe because of that particular year they went under a shock, and so they didn't have an income, so they had to consume anyway. And so it doesn't matter because people move around in these deciles. But it's not that so easy to move around at this island, and especially if we were to draw these same pictures, instead of grouping people by this side, we group people by education level. Again, the savings of the most educated will be much larger and then the savings of the least educated. And education is a fairly permanent characteristics for throughout the lifetime. So this is a problem because the poorest people find themselves into a poverty trap, which they cannot save enough, they cannot finance any accumulation of physical capital, nor they can finance the education of their offspring, and so it creates a poverty trap, and it reduces actual saving at the global, at the national level as well, at the macro level. Here you see again the projection for savings in Mexico when we account only for what happens in the demographic composition of the population. But if we can account for an improvement in education, so that gives people more opportunity, more earnings capacity, they will be able to save more. And actually, even without a very large effort in terms of education, you can see that the saving rate can increase at the macro level by about 5 points. But again, savings, increasing the savings through education is a challenge, is a difficult policy, and it takes action to begin now to get results in the future. One final challenge in terms of, or two more, then I'm done, but I mentioned that aging by itself creates some pressure on the government sides for pension expenditure, for health related expenditure. But there is also something that comes from the micro side. With development, the household structure changes. Here you see that the population above 65, the male proportion of male that are still head of household in low-income countries is about 71%. Okay, so of every 100 persons that are above 65, only 71 maintain their head of household status, against 90% in high-income countries. So that means that still about 30% go back and live in a larger family where the head is their son or others. So, but with development, this changes, and so the informal multi-generational household become a smaller household, and so old people they have to support themselves through more formal system, through either the pension system or the financial accumulation of assets, etc. So this is sort of an additional pressure that comes on top of the aging itself. Finally, on the capital flow side, here you see the same picture that I showed you at the very beginning, where the importance of high-income countries in terms of gross capital flows still is very large, and this is just in terms of percentage. So you see 2010, the blue part of the picture is still the importance of high-income countries in this, and this is decreasing in the future, which the implication of this that this graph highlights is that there will be a lot of intermediation will not go through anymore the north of the world, but there will be much more intermediation within the south. So there will be a lot of flows that will go between China and Africa, and we see that beginning already. There will be a lot of flows between India and China, and also between Africa and itself, and so on and so forth. And that has implications for the macro management of the of country economies, but of the global economy as well. It has implication for the predominance of currency, international currencies, that in a world where 2/3 of savings and 2/3 of investment are in developing countries, having still the dollar dominating international transaction seems a little bit far-fetched, perhaps. So I stop there. There is, unfortunately, I was very conservative in terms of printing books for this report, so we actually ran out of copies. But everything and more is available at this site, the worldbank.org/capital for the future. There you have the full report, obviously, but you have also a lot of interacting tools where you can actually change some of the assumption and get new numbers. You can download all the data that we have, and most importantly, if you click a lot, I get points with my director. So that's very useful. Okay, thank you very much.
Thank you both. That was an intriguing look at the future, but should I hang on to my dollars a little bit longer or shift rapidly to a basket of currencies? Let me invite our two Wilson Center stars here to provide some commentary. Well, it's my pleasure to introduce two distinguished commentators here from the Wilson Center. To my immediate left and your immediate right is Chihoko Goto. She is a senior associate here in the Asia program, and her portfolio includes Japan, South Korea, and Taiwan. She is by background a very experienced financial journalist. She started life with a degree from Oxford and a graduate degree from Waseda University, which I learned has an outstanding rugby team, which is my personal passion.
An American team, too.
And to her immediate left, and your further right, we have Christopher Wilson. Christopher's a senior associate in the Mexico Institute here. He's quite an authority on U.S.-Mexico interactions on the economic side, has a number of publications that I recommend to you that are available on our own website here. And he has a Master's in International Affairs from American University, which is appropriate for taking a look here at North America. So I've asked each of them just to speak briefly on the specific aspects of the report, where in addition to the broad outlines that you've heard described, there were some looks at the specific region by region in the developing world. So Chihoko, why don't we start with you, and then Christopher will move to you, and then we'll open it up for questions.
Well, thank you very much. Instead of providing my own personal analysis of what the report said, I thought I really wanted to boil down three questions that really struck my mind as I was reading this report from an East Asian perspective. It's very striking that amongst the BRICS, India and China are really the powers that really dominate the global investment field moving forward, and that population growth really plays a very key role in this. But what is interesting is what Mauricio stated during his presentation, that China is already seeing a downward trend in its worker to non-working persons ratio. And China is really, as you know, is surrounded by what's called aging societies led by Japan. Japan currently, the percentage of those over 65 years of age is already at over 20%. Some project that that rate will actually increase to nearly 40% by 2050. And while Japan is the severest of them all, it's followed by South Korea and Singapore. And given the aspirations that China has and the economic growth that China is having, as well as a slew of other social concerns, my belief is that China is perhaps not as drastically, but heading towards this. That's one thing. And then, of course, here in the United States, there is the whole idea of an aging society is not as dire as it is in many East Asian countries. But there is this problem of trying to meet unfunded debt to retirees, and we see that explosion with the filing of bankruptcy by Detroit earlier this week. And Detroit obviously was not alone, but it was the biggest of some of the municipal governments that did file for Chapter 9. And I believe that we can expect more local governments to follow suit. All this really brings into question how do we meet those challenges of meeting the needs of retirees who require more services, and we need more budgetary resources, and past policies are no longer an option. There are many steps, for instance, that Japan sees it could take at the moment to meet these fiscal challenges, but there is a political deadlock, and it is easier to, even in Japan's case, to brush these issues aside and wait for another day, another government, another leadership to take on what are issues that really should be taken on now. So I wanted to know, firstly, whether you did have any policy prescriptions specifically to Japan, but to a lot of East Asian countries, and whether China could already begin forward-thinking those issues and taking preemptive measures to meet those future concerns. My second question is really the impact of political risk on capital flow. And we do talk very loudly from where I stand about this so-called Asian century. But unlike the East Asia miracle, that really amazing report that the World Bank released 20 years ago, we are seeing a lot of political risk emerging in East Asia. And whilst China's growth over the last 2 decades in particular has been amazing, together with its economic might is coming this rapid militarization. And that kind of militarization is leading to political as well as social change. And part of that change is also reflected in the so-called Chinese dream, that aspiration of China wanting to do more, be heard more, have more impact. And my own belief is that one of the results of a lot of Chinese militarization is an overconfidence by the Chinese, which is leading to territorial disputes in both the East China and South China Seas. And such disputes and such tensions are leading to tensions not just between China and Japan, but also the Philippines, and it's also leading to tensions across the board. And I'm not even going to touch on North Korea and the political risks there. So far, it seems that these tensions are not impacting the financial markets. And so far, it seems like the capital flow between Japan and China are not being impacted to date due to these tensions. But I assume that there will be impact, a negative impact, and I wanted to know how that kind of political risk, broadly speaking, is accounted for or can be accounted for in a report like this. And it would be interesting to see that. And finally, the question I have is about the environment, the global environment that we find ourselves in, and Asia. One of the things that come with growing wealth is the heavy impact on natural resources, and a lot of Asian countries, especially Japan and South Korea, have been at the forefront of developing new green technologies, everything from shying away from a carbon-based energy source and looking more towards renewables and really trying to develop everything from smart growth of cities to more environmentally friendly mass transit systems to encourage sustainable development. We've seen from a financial perspective the development of carbon trading markets, and I wanted to know whether are there financial instruments that Asian countries can really play a leading role in to create a new financial market that goes beyond the existing one to reinvigorate themselves. Also, we talk about public spending and infrastructure development. Do the challenges of higher demand on natural resources change the equation in any of this? And to conclude my thought on that, I want to know whether the depopulation of East Asia obviously is to its disadvantage, but can it invest more in things like green technology as their elixir of youth, so to speak, to offset the fact that they do not have a robust population? So those are my
three challenging comments and questions. And before we ask the World Bank to respond to those to start, let's have Christopher Wilson and your thoughts on the Latin American portion.
Thanks so much, Ken, for the invitation to speak with you all today. And congratulations to both of you for what's really an excellent and more than anything, really thought-provoking a report, asking us to sort of stretch our minds to think about what the world might be like quite a bit out into the future. I mean, I was struck by something, and it was mentioned during the presentation, that in putting together a report like this, you have to take in some assumptions, and you did a good job of sort of hedging that by putting in different scenarios. But one of the assumptions that's really built in, I think, is one of the things that's hardest to predict, which is that that there will be a continuation of needed reforms. And so I think it's interesting to look at what some of the policy implications are of a report like this. I'll try to just point out a few things in the Latin American context that the scenarios bring out, and discuss especially some of the policy implications that those might have for the region. The first way I want to do that is just by looking at investment by sector in Latin America in particular. There were a few really interesting things that came out by breaking it down, sort of services sector, manufacturing versus agriculture. And the sort of general trend would be that as countries develop, you'll have more and more growth of the service sector as a portion of GDP, therefore more investment in the services sector as a portion of total investment also, and that's, I think, the trend that they expect, generally speaking. But there are some interesting sort of different cases there within particular countries. So Brazil stands out as a very interesting case as an agricultural superpower. And I think there's some very interesting potential there, specifically because the two areas of the world that are pointed out as sort of maintaining or even growing investment in agriculture are Brazil and Sub-Saharan Africa. Sub-Saharan Africa is sort of the obvious one. It's a place where there's less of this shift that's been happening or has already happened towards manufacturing and then towards services. But Brazil is a country that has made a lot of that shift, but has maintained a sort of specialty in agriculture, specifically a specialty in agriculture in tropical regions, which would also be the type of agricultural investment that we'll see taking place in Sub-Saharan Africa. There's geographic proximity between the two. There's already some political linkages between Brazil and Sub-Saharan Africa. So I think this presents a really interesting opportunity thinking forward, is how can Brazil really take a leadership role, not only in its own sort of growth in the sector, but also in innovation in the sector. I mean, at a recent forum that we had here at the Wilson Center, someone from Mexico, Enrique Dussel, made the point that it's not so much what you produce, it's all about process. It's all about being the innovator in whatever field it is. It doesn't matter if you make a simple widget or you produce soybeans or what. It's what's really important for your economy is then taking the lead in innovation in that sector and developing, in that direction. So I think that presents a real opportunity for a country like Brazil to be thinking about how it can become a leader and innovator in specifically agriculture in tropical areas. The next sector I wanted to mention is, this is a little bit of an addition or different separation, but is energy and natural resources. again, I think the report mentions that energy investments are expected to be high in the future, especially as new drilling techniques like hydraulic fracturing and horizontal drilling spread throughout the world, and we sort of see what's already happening in North America in terms of accessing new deposits of natural resources spreading to other parts of the world that will obviously open up big investment opportunities in those portions of the world. We've seen already a trend in Latin America, some big investment in petroleum resources, but also minerals. And I think we'll expect that trend to continue with some variance into the future. But the particular thing that Latin America stands out for is the resources that it has in shale structures, shale gas and shale oil. Some of the biggest holders of those reserves in the world are in the Americas. So the United States, Argentina, Mexico, Canada, and Brazil are all among the sort of the world's top holders of shale resources, are expected. Some of them are yet unexplored and confirmed holders of those resources. So what happens there will be a really interesting thing to watch. And it also has huge policy questions or policy implications in it, precisely because some of the countries on that list are places like Argentina and Mexico especially, but even Brazil to a certain extent. There are big policy questions about opening up energy sector to private investment or having the right climate for private investment to be allowed. So I think there's a lot in the hands of those countries to determine whether or not they will be on the receiving end of those potential investment flows that are out there that are predicted in a report like this. And then finally, manufacturing. Manufacturing investment has been high lately, sort of as a whole globally. And in the report, they expect it to continue to be high, even as we see this broad shift towards services investment as countries develop. And as a country like Mexico really stands out. I suspect that countries in Central America may be in a similar basket, but we have this interesting sort of break between the countries of Central America and North in Latin America and South America, where the countries of South America have been depending much more on energy and natural resources and agriculture, and the countries to the northern side very much so on manufacturing. You see in their predictions that manufacturing investment in Mexico will continue to make up sort of a broader share of investment than expected as things change in other countries. So I think you see in that respect Mexico sort of developing, thinking way out there, but more into a German model where manufacturing stays a large portion of the economy and a large portion of investments going to manufacturing than you do see like heading towards sort of a U.S. model or another model like that. And then I just bring up that same question again that I posed to Brazil. The question would be for a country like Mexico then, how do you take advantage of that so as you move into more services, essentially services connected to manufacturing, R&D, et cetera, how does Mexico situate itself to be a center of manufacturing innovation in the future so that it can successfully attract also the related services investment that could come along with the manufacturing investment if it is to make those sort of right policy decisions. And then just a couple of quick comments on the development of financial architecture and then physical infrastructure. In terms of financial architecture, and this one I really like to sort of pose as a question also, but I think one of the big policy implications of the report is that developing countries need to develop their financial sectors in order to attract this capital that's potentially out there for them. And then I would also say that along with that, they probably need to, and I'd love to hear more about this piece of it, develop their financial regulation in order to protect themselves from crisis in the context of these potentially increased flows of capital to those countries. I think as that shift in investment from the developed to the developing world continues, we can probably expect mistakes in capital allocation. We can probably expect bubbles and bursts and just simply misallocations of capital, some sort of oddities in the financial market as investors learn how to work in this quickly evolving and very different world than the one that we live in right now. So I guess my questions are sort of what are the associated risks with this scenario that you're presenting? And how, I think in a more balanced world, there will be fewer countries with the capacity to bail out other countries in a multipolar world. So what does that mean, again, in terms of financial stability? What does it mean for are the needs that are be placed on organizations like the IMF, international organizations? I think there are a lot of big questions that this brings up in that respect. There are two examples I wanted to point out of policies to develop financial capacity that are happening in Latin America, and one just in Mexico, the country I'm most familiar with, but that are just sort of interesting to think about in the context of these growing capital flows in developing countries. The first one is the effort that's underway to integrate MILA, which is the unified stock market between Chile, Peru, and Colombia, with the Mexican Bolsa. So there's, in the context of the Pacific Alliance, which is a trade and integration effort among these four countries, there's an effort to integrate the stock markets of Mexico with what's already an integrated market of these Pacific countries in South America. I think this is a really interesting way, one small but one interesting way for developing countries to try to sort of take a jump ahead in capacity for financial intermediation without just sort of waiting for GDP growth. And we're expecting GDP growth to grow faster in countries like this than we are in the developing world, but instead just sort of waiting for that to change financial flows, taking a proactive step to try to attract and intermediate financial flows themselves. And the other just right now is just an interesting point is that Mexico's Congress is actually right now considering a financial sector reform that I think gets us thinking in the direction that maybe a lot of other countries should be considering given these potential changes in flows in the future. They're looking at things like strengthening their national development bank, encouraging banks there to lend more, because this is really a small amount of credit compared to the size of the GDP of the country. But also forcing them to compete more, using consumer protection and increasing of banking, access to banking as ways to increase lending. So really safe ways of increasing lending, I think, if it's done well. So it'll be really interesting to see, but I think there's a big challenge in a country like Mexico to expand banking to all and social programs. I mean, we saw the sort of the savings issue and the issue of inequality in Mexico and how it plays out in savings. So it would really be a challenge for the government to use both financial sector reform, but then also things looking at policies in education and health and anti-poverty programs in order to try to let increased investment, to one, attract increased investment, and then one, second, to make sure that is given, creates inclusive growth, basically. And then finally, just the development of physical infrastructure. I think the report identifies infrastructure as a challenge. It identifies it as a place where there's a lot of need for investment, but is also one of the types of investment that can be challenging for countries to attract, for developing countries to attract, because it's long-term, because the structure is very complex. And then specifically in Latin America, we've seen a really interesting trend where infrastructure investment, as pointed out in the report, fell from something around 4% of GDP in the 80s to around 2% of GDP in the past decade. So we've seen actually a decline in infrastructure spending as a percentage of GDP. I think we may be seeing even more recently a sort of re-uptick in some of that. But the big shift is that it's a shift from traditional government financing and running of infrastructure projects to more complex procurement processes involving the private sector, and also, very importantly, public-private partnerships. So working with the private sector to make those investments, and those specifically, public-private partnerships, are really complex instruments that need to be created. So I think that maybe this also sort of points a new direction for, so one, you have this huge need for it, and then two, you have this huge amount of complexity, but you also have a growing GDP in these developing countries, and specifically in Latin America. I think that points towards international institutions and even governments really being able to set up tools for technical capacity, enhancing technical capacity, so that because it's not so much about necessarily just pumping money into infrastructure. It's about helping countries and municipalities enter the bond market, structure their programs appropriately so that they can access capital from the private market. So maybe a little bit of a shift in the type of infrastructure investment that's and support for infrastructure investment that's needed. I guess just very quickly, finally, they mentioned rule of law issues as an important policy implication of a finding in the report. And I think this is just extremely obvious of how important that is in Latin America in particular. You know, on the one hand, you have the need for investor protections, consumer protections, business protections, et cetera. But on the other hand, you also have this public security challenge that so many countries in Latin America are facing right now. Public security, sort of citizen security from youth gangs, but also issues of organized crime. But sort of the broad answer to so many of those issues is really efforts to strengthen the rule of law, so that the law is applied equally to all segments of society, which means both for investors and for public security. So I think that's clearly one of the major challenges that Latin America will be facing in the coming years in order to set itself up to be on the receiving end of this boom of investment that's potentially out there.
Thank you, Chris, very much. Well, you can see how your report has stimulated thinking and has got people wondering, well, what policy steps? You mentioned the need for policies and institutional change, and you have both of our speakers asking very kind of specific questions. Why don't I give you just a brief chance to respond. First to Shihoko's 3 questions about how do you deal with retirees, something that might at some point be of personal interest. The political risk question, how that's going to affect capital flows, and then of course this demand as a rising middle class wants steak for dinner rather than traditional meals, and what does all of that mean for its pressure on global resources. And then I'll give you a chance to take on Chris's questions as well. Hans or Mauricio?
I have a few things, but
Oh, perhaps you start and then I'll complement. Yeah.
all right. Okay, sure. So I choose.
This is Alphonse and Gaston here.
That's good. No, thank you very much for the questions, both to Shioko and Christopher. I may group them, in fact, a little bit, although I know that they are for 2 different specific regions. But let me go to the third questions on environment. I start from there. Indeed, it's a very important for the long term. We have in our studies we have tried actually to not in this specific but in similar study we have tried to do some stress test. So what can really destroy some of these long-term trends that seems so important and so strong in the future in developing countries. And indeed, the only real few scenarios where there is a breakdown of these global trends is where there is a major environmental disaster that is really disrupting growth for a long term, for a decade or so. A financial crisis like the 2008 and 9 doesn't derail this, so we can sort of simulate one of these. It has long-term consequences, but it doesn't derail the scenario so much. So the environment, how the impact on natural resources is important, and we haven't, in this specific report, we haven't looked into that, but it is important also for saving and investment. And the reason is as follow, because when for two main issues are related to that. One is that it's difficult to foresee technological changes in the exploitation of natural resources, and it's also difficult to forecast where new natural resources will be discovered, so this is fairly uncertain. And the second reason is more related to the economic policy related to that, so that when there is a boom in the natural resources, when there is a change in the price, there are enormous rents that come with the discovery or the exploitation of a natural resource. And these enormous rent then can be beneficial or can be detrimental to the country and to the population or to the citizens of the country. To give you an example relevant for Latin America, that you also mentioned the importance of natural resources, Colombia has discovered a large amount of oil. And last year, the Ministry of Finance, Echeverri, did change the royalties law that is related to that. And I knew him because I married to a Colombian and I traveled quite a lot to Colombia. But one of his main issue with this natural resource was that, look, we are at the crossroad. We can either become Venezuela in 10 years, or we can be Chile in 10, 15 years. And the way Venezuela has used its natural resources is completely different from the way Chile has used its natural resources. There is no saving fund for oil, where there is a saving fund for copper. During the crisis of 2008 and 9, Chile has been able to use some of these resources to repair from the damage of the crisis the poorest people. Venezuela doesn't have that opportunity, so it's truly important. One other comment, one other answer to the comment is the issue with the fact that the sectoral shift towards services that you have emphasized. One big challenge is that it's normally the service sector is the most protected and most regulated sector of all. So it's not by the simple fact that as income level rise, the amount of money spent on services increases, and so the service sector increases as a share of the total economy. But the investment opportunity don't just come because of the size increase, but come because the service sector is well regulated. It's clear. The property rights are clear. There are examples in telecommunication, in financing, and also in high-income countries has been the sector where liberalization has come last, good regulation has come last, and so on and so forth. So we don't account for that, but if you go into the detail of each country, there are very large challenges how to make an investment arrive in the country or be productive in the country in any of these important services. One last comment on the financial sector. We didn't want to go into the detail how to design a good financial regulation, a good financial sector, because it would require perhaps a whole report in itself, and we are not sure that we may get it right even then. But I tell you one small thing related to Mexico and the reforms there, and specific on the financial sector. The Mexico ran a very important and successful education campaign related to the use of remittances. Indeed, remittances are an important flow of savings coming into the country or investment coming into the country, but most of the remittance receivers are not financially educated, and basically the remittances, instead of becoming a source of investment, a source of growth, were consumed. And a campaign that educated the remittance receivers in what to do with those, how you can invest them in the financial sector, and how can they be used to finance education, etc., changed the way remittances were used. So there are even small things that can be done, and can be done successfully. So I leave the difficult one for us.
Hans, just a brief comment, and then we'll go to questions from the audience.
Yeah, sorry that we take so much time
We have a lot to
in the
talk about. and it's
presentation,
a
but we have a
really
lot
rich,
to talk about. But first of all, thanks so much for all these comments, because that really puts the flesh on the bones of the numbers that we shown and the real life challenges. Christopher mentioned the challenge of the continuation of the needed reforms. I think that is really at the center of all the debate. That explains the success of developing countries of the last 15 years, the approach to reforms by many governments, and it is at the center of the debate on the challenges in the pension system, on the green technologies, and on the financial sectors. And I think in all those areas, fascinating things are going on in the developing world. I want briefly to give some examples there. I think where there will be most of the debate is on your point of the political risk of capital flows and the broader point of the rising power of the emerging countries, including China. I think that is the most important challenge for countries like China, but actually also for countries like the United States and for the global economy. And I would say that the main problem is, in my view, more that China has not found its global voice yet, is not confident enough to play that role, instead of China being overconfident and trying to impose too much power on the world. I think the political influence of a country like China, the role of China in the provision of global public goods, in showing leadership in global solutions, is far lagging their economic importance, and that becomes at some point a serious problem. But first on these reforms. For me, the big difference between developing countries and high-income countries is the desire to reform economies, to look ahead, to see that the world is changing and to adjust to that. I was part of a World Bank team that worked with the Chinese government the last 2 years on their big challenges the next 20 years in China 2030. And it was just amazing that a country like China is willing to reverse almost completely their policies that have been so successful the last 30 years, because they realize that the future is very different, and that those policies that were successful in the past are no guarantee that there is success in the future, and that they will have to change their regulations to continue productivity growth, that they have to move into other sectors, that they have to liberalize financial markets, open up to global financial markets. And that was the problem in a country like Japan, I would argue, why they ran into all kinds of financial problems also, and ended up with 20 years of basically no growth. When they reached the end of the road in the manufacturing sector, and they could no longer catch up and generate high growth, they had to find a new source of growth, which was there in the services sector, which was very protected, with very low productivity rates, and for political reasons, they didn't open up the service sector, they didn't want to reform. Those emerging economies that are so successful now will have to take those kind of steps to completely change their policy and open up new sectors. Otherwise, they will follow the countries like Japan, and they will stagnate. And when you are able to increase productivity and you continue growth, then suddenly the picture of the pension funds will be very different, because that can only be solved with productivity growth. The same is true for green technology. For me, it is very logical if China ultimately becomes a champion of green technology, because China has pushed itself into a very energy and natural resource intensive economy. And that is the main bottleneck for future growth. And especially when you see changes in other countries, you don't want to be pushed further in that direction. And they are moving very fast now, trying to become much greener in the way they design their cities, in shifting away from heavy industry, and by developing the new technologies. And because there's still so much of the capital stock to be developed in China, they have a great opportunity. And like England set a standard with the steam machine in the Industrial Revolutions. You had Ford setting the standard here. Then you had the lean production in Japan. It's quite logical that you have a green standard 10, 15 years from now in China. The financial sector, the same. I don't think that the big problem is how do you prepare yourself for big inflows of capital and misallocation because there is so much so much need. I think the big challenge is how you mobilize your domestic saving and how you facilitate the outward investments that you need when you develop more and that you need to internationalize your own companies. And the misallocation is happening at the moment in developing countries. In many developing countries, including China, but including many Latin American countries still, you have financial repression. While the problem in the West was too much deregulation, over-leveraging, and too broad financial institutions, you have the opposite problem in developing countries. There's under-leveraging, there's over-regulation, and the financial institutions are too narrow. You have no capital market. It's very difficult for small and medium enterprises to get finance. So you have to reform those markets in a very short period of time. I think you can be relatively optimistic about all the efforts going on in developing countries to anticipate those challenges and to reform. I'm not sure you can be optimistic about the increasing role that developing countries have to play in the global arena. And that is partly because high-income countries and the vested institutions, they are not ready to make space for the new players at the table. And that is a huge challenge for those countries. And too often, whether it's climate change or trade policies, all the proposals are developed in high-income countries. They have the vested interests of high-income countries. Developing countries look at them, they see, they try to understand what is in it for them, then they said, no, thank you, and by the way, it's your problem. What we are trying to do with many developing countries is to start think about global solutions, not only about their own solutions, but global solutions. How would you address a global issue like climate change from your background? And then put that on the table. And I think we are far from that. And that's partly because we are afraid that countries like China indeed become more global powers.
Very stimulating, more stimulating thoughts. We have time for just a few questions. If you the gentleman here, if you'll just wait till the microphone, then the gentleman in the middle there. And if you could please, as soon as we get the microphone on, if you just identify yourself.
Yes, I'm Anthony Odie. Anthony Odie, formerly with the bank, now consultant. Fascinating report, very promising new series. My question is, your presentation this morning, you've given us essentially aggregated views of both savings and investment. And I wondered the extent to which the report breaks things down. I'm thinking about 3 or 4 dimensions. Final purpose of investment, are we talking about infrastructure? Are we talking about directly productive investments? Passing through primarily public, primarily private sources, investments coming primarily from domestic sources. You made the point the savings are going to expand as well as investment. Presumably a great deal of this is financed nationally. And finally, on the international side, to what extent we're talking about FDI, portfolio investment, official channels and so on. So to what extent those kinds of breakdowns add additional insights to what you've already given us.
Let's take a couple other questions. I think the gentleman in the middle there and then the gentleman on the row.
Good morning. My name is Aaron Tyrell Mitchell. I had a question about immigration. Given the decline in working age population faced by many high-income countries, do you foresee a significant change in immigration policies in these countries that are designed to attract younger workers into those countries? And if so, what impact do you foresee on that, on your savings and investment models and the flow of capital investment?
Let's take that question from the gentleman on the aisle there.
James Sang. Maurizio, in answering Ms. Godot's question about environment, you used the word major shock. Can you be a little more explicit as to what a major shock that would have a big effect on your models would be as compared to a, quote, minor shock?
Let's take the lady's question, then we'll give our distinguished commentators and presenters a chance to respond.
My name is Graciela Reyes. I'm the former representative of Uruguay to the Organization of American States. And my question is, how do you foresee the future role of other economic international organizations? For instance, the ending of the Doha round of multilateral trade negotiations within this scope. And also, what possibility is that all the Southern Hemisphere integration schemes, like Mercosur, UNASUR, and even the Trans-Pacific Partnership Agreement will succeed within this future? Thank you.
Which of you would like to start? And then we'll also call on Shihoko and Chris for... one of those questions was specifically directed to Maurizio. I think,
Yes, okay.
what's a big shock and a small shock?
Well, sure. Okay. I think what I meant is that some of the trends that we have highlighted in the report depend on demographics and capital accumulation, and they depend on technology catch up, and these trends are fairly strong, and it's difficult to disrupt them. So a minor shock can be seen by the media as a major shock. So a change in the price of oil, for example, can be seen as a major shock, but it's just a change in a good price, and it cannot disrupt the demographic or the technology catch up, and therefore it doesn't really change the growth forecast that we see. An environmental shock instead that changes the productivity of a country, and therefore its capacity to grow can be seen as a major shock. So that's what I mainly had in mind.
What does that mean specifically? Are we talking about earthquake? Are we talking about water disappears?
Well, it's global warming. That we have other reports that look into environmental scenarios, but it's increase of extreme events, but is mainly changing in the temperature that creates problems of productivity in the primary sector, that creates large disruptions of the productive capacity of a country. So that's what we think about.
Let me say something about immigration and the Doha round, and perhaps you can say something about the breakdown of investment. Migration is very important in development, not just international migration, but just think about urbanization and the huge flows of migrants within big countries. That's very important, will continue to be important. However, I don't see migration as the solution to aging, for example. If you run the numbers, then you can postpone it for some time, but ultimately you don't solve it, and you will have to address the issue of aging head on. In the process of globalization, I see two-way migration becoming much more important for developing countries than just one-way migration trying to solve a problem in one or the other country. And you see now a lot of return migration to India and to China. And that's where you see that migration has become very important in the transfer of technologies. Again, an example where a country like Japan has not been very successful, has been very closed, and cannot benefit as much as it should have from these global networks. So I don't see migration as the solution of that. The institutions, what happens with the Doha round, what does this all mean? I think one of the problems of the Doha round is the problem of the WTO, that everything is done by consensus, and you have so many countries, and every country wants to have an exception, and so you never get a resolution. That is a problem. You need systems where fewer countries that are really important for certain issues can take the lead. But then the big challenge is what I mentioned before, is that we need different leaders. We need countries like Brazil, like India, like China, to become not just participants in the global process, but really leaders in the global process. And you can argue that the G20 is a first step in that direction, but it's a very small step, and it requires a complete change in mindset in those countries and in the high-income countries. And then on trade, on climate change, then we can expect breakthroughs.
You can talk about investment.
Indeed, Anthony asked about how much insight you gain by going beyond the macro aggregate picture, and you gain quite a bit, but it's also difficult to present the global picture, because what you gain is specificity in different countries. So when you look at the investment from the point of view of private and public, or by sector, you have to talk about specific countries, and we do so in we have various examples. For example, in infrastructure, one challenge that can be more common across countries in how to set up the private-public partnership for infrastructure investments that are important and become more important in the future. Savings likewise. As I presented, we look at the disaggregation between private saving and public saving, and within private we attempt to look at the household private sector and the corporate sector. Again, if you look at China, there is a large literature that looks at how savings will evolve for the household sector and for the firm sector. That is, as Hans pointed out, one reason why there are so large savings is financial repression, but this will change. So the large savings that are now in the corporate sector, public corporations, will probably change and will drive down savings on top of the demographic trends. So indeed, we go into a lot of granularity for, let me mention this, that for 4 countries, specifically Ghana, Mexico, Russia, and Thailand, we go to the level of the household level. So we have microdata. We follow individuals throughout their life cycle, because we have household survey that go from basically the 80s to 2010. So we span 30 years, and we can follow age cohorts across these 30 years of their saving behaviors, and we discover interesting things. How new cohorts save more than old cohorts in most of the countries. How demographic plays out in Russia versus young countries like Ghana. So we add a lot of granularity that we didn't have the time to present in half an hour or so.
Shihoko, Chris, any responses to these questions?
I just want to add one thing about immigration. I found what you said very interesting, that immigration is not a solution to an aging society, and I'm sure the Japanese policymakers in particular would be very happy with this response, because unfortunately both Japan and South Korea are not really addressing this issue of immigration at all. And I think it is to the detriment of the countries, not just because it is not because it could, potentially, maybe at least in the short term, provide a band-aid to this aging issue, but also it does bring the more nimbleness and flexibility of society that really is going to trigger change, and that Japan and South Korea are also not open to the two-way migration that you've pointed to, and I think that should be something that policymakers should address, not just for a single solution, but for more comprehensive change of society.
Chris, any?
Just very quickly about the international sort of deals and integration schemes that are out there. I mean, I think we are in a period of sort of super deals where linking groups of countries together rather than just an extension of the period of bilateral trade deals. So I think there's a lot of potential out there to consider the unification of different groups, but obviously there are a lot of political challenges in doing so, not to mention the economic challenges in doing so. But there's a potential that with some success in that front, which is sort of still ahead of us to achieve any major success on either a TPP or the TTIP with the US and the EU, things that are big enough that they might actually incentivize progress on the multilateral front. But I think that may be a way outside of the actual structures of the organizations like the WTO to bring together these groups of leaders that could then force the issue on everybody else. It's sort of, join in or be left out at that point. And I just have to take advantage of this opportunity to then say that we have an event exploring the idea of a North American EU trade deal as TTIP and the US-EU trade deal is being considered, asking the question of what's the role of Canada and Mexico, the NAFTA partners, in that coming up this Friday morning. So you're all invited to that as well.
I think this has been a terrific discussion. Hans teed up a very challenging question about a more rapid shift in economic presence and power than there is a shift in terms of providing sort of global public goods. It's a tension that we'll try to return to it in a future event. I've kept you well past our promised witching hour. It was really a product of very rich presentations and a report that should have us all thinking clearly about the future. Please join me in a round of applause for our commentators and terrific presenters.
These super regional trade agreements are an example from the. There is still too much dominance.
Thank you so much. I really enjoyed